Asset rules. Hey everyone, Adam Bergman here, tax attorney and founder of IRA Financial. On today's AdBits, what are the plan asset rules and how do they interact with an IRA or 401k investment? So the plan asset rules are an area of rules that are part of ERISA, promulgated by the Department of Labor, that actually impact the way IRAs and 401ks invest in investment funds, particularly hedge funds, private equity funds, venture capital funds, even real estate funds. And it's a set of rules or a term that is often misunderstood. So whether you're using personal funds or retirement funds, if you're looking to make an investment into an investment fund, then you actually have the time to take a look at the documentation, the subscription documents, the private placement memorandum. You're generally going to see language involving the terms plan assets, okay? And the reason for this is the plan asset rules, essentially, if they are triggered, they potentially can cause the investment manager to have a heightened duty or responsibility to the investor, which is aligned with the ERISA rules, which puts the investment manager potentially in a more difficult position and a position that requires more regulatory framework and more regulatory focus. So if you are an investment manager, meaning it's your fund, you're the general partner, you do not want to trigger the plan asset rules. Okay, that's number one. You're going to trigger ERISA, potentially trigger the prohibited transaction rules, and you're going to cause yourself a lot of regulatory headaches. And you can also potentially limit your ability to earn fees, commissions, and be involved in the underlying investments of that fund. Okay, so as the name suggests, plan asset rules mean you basically are looking through the partnership or the business to basically treat the assets of the plan or the assets of the investment as part of the plan. So it's kind of a look-through rule. And basically, if you trigger the plan asset rules, the investment manager is basically deemed to be touching the assets of the investment and kind of have that connection to the IRA or 401k. Whereas if you don't have a trigger, you don't trigger the plan asset rules, there's no connection that is directly linked. It could be indirect, but it's no direct link between the 401k or IRA and the underlying assets of the plan. Okay, so it gives the investment managers a lot more freedom to act because they're not worried about triggering ERISA or any IRS prohibited transaction rules. Okay, so basically, this is how the plan asset rules are triggered. Okay, if an IRA or 401k or a conjunction own more than 25% of a look-through entity, okay, like partnership, a real estate fund, a venture capital fund, private equity fund, more than 25%, the ownership or asset value, the plan asset rules are triggered. Okay, so that's why if you have 100 investors, you can't have more than 25 IRAs or 401ks, or $100 million, you can't have more than 25 million. That is why if you look at this documentation, it's going to be very, very clear that if we do trigger the plan asset rules, hey, you're on the hook, or number two, we have the opportunity to get around these rules and redo some of the ownership. So no investment manager wants to trigger the plan asset rules. And that's why they're going to be very careful in these funds about how many retirement accounts they're going to grab. They're going to want to be under 25%. So if you're raising $10 million, you're going to be under 2.5 million of retirement accounts because you don't want to trigger the plan asset rules. And some investor managers say, well, I don't care. I'm not going to do anything. I'm just getting a flat fee. And that's fine. It adds a lot of regulatory risk. So if you can avoid it, you want to avoid it. And most large investment managers at large funds want to avoid it. So again, under 25%, you're good. Or if you invest in a business, an operating company, right? If you invest in Tesla or Apple, you can have more than 25%. Retirement accounts, you have no worries. So that's why when you buy Apple or Google, there's no language about plan assets or the shareholder restrictions on, oh my God, we have too many IRAs that own Apple. So it's less than 25% and invest in an operating company. So there's also some further exemptions if you, for example, invest in something called a venture capital operating company. So a VCOC is something where the plan asset rules, okay, will not apply. And it's basically a fund that's investing in active companies where the annual valuation period, at least 50% of the assets, okay, valued at cost, are invested in venture capital investments, right? So they want to encourage venture capital investments, and essentially you're investing in operating businesses. That's why it's basically, they're treating it as an operating company. So instead of being 100%, it's 50%. As long as the venture capital firm's assets are invested 50% or more venture capitals, you don't have to deal with plan assets. Okay, and then there's something called real estate operating company, or REOC. And that says that if at least 50% of the assets are invested in real estate that is managed or developed, and with respect to which such entity has the right to substantially participate directly in the management and development. So not just passively in rental income, you got to manage and develop the real estate, then you can get around the plan asset rules. Okay, and again, the idea is that, hey, if you're investing in operating businesses, even if you do it through a pass-through fund, we're going to treat you that you're not in the plan asset rules. Okay, so under 25%, or it's an operating business, and an operating business can also be a VEOC, a venture capital operating company, or an REOC, a real estate operating company. More than 50% of the assets are invested into businesses in the venture capital world, or the real estate world, management or development. Okay, so that's more akin to businesses, less if it's other types of passive real estate. So again, if you're less than 25%, you have a fund, 12% are in IRAs, you don't have to worry about plan asset rules. Okay, you're good. If you are investing in a venture capital fund and most of the assets are invested in businesses, 50% or more, you don't have to worry about plan asset rules, even if more than 25% of the venture capital fund is owned by IRAs or 401ks. Same with the real estate operating company. If 50% of the ownership is in IRAs or 401ks, as long as you satisfy the definition of an REOC, you're not going to trigger the plan asset rules. So why, again, do you not want to trigger the plan asset rules? Well, basically, when you are subject to ERISA, you have a heightened duty of care. Okay, you're basically a fiduciary, and you're required to act with the care, skill, prudence, and diligence under the situations then prevailing that a prudent man acting in a like capacity and familiar with such matters would use in the conduct or enterprise of a like character. So that means if you make a bad investment, you're deemed a fiduciary and you have a heightened duty to your investors. So that adds more risk. Or let's say you're doing a deal where your fees, maybe relatively high in comparison to other deals as an investment manager. If you trigger plan asset rules, you will be deemed to be a fiduciary under ERISA, and you have a heightened duty of care, skill, and prudence, and maybe that source of payment could be deemed not in the best interest of the client. Or if you make a certain investment that's highly risky, like a hedge fund, which most of the hedge fund investments are risky, but you then have to take into account every single client and think about their best interests. You have to do diligence, skill, care, prudence. And again, you may satisfy those requirements, but it adds more risk, more regulatory capture, and a larger regulatory framework that you're going to have to navigate. Versus if you're not triggering the plan asset rules, you don't have to worry about this heightened duty. You just have a normal duty of care, whatever it would be under any investment manager. So, and that also means you could trigger the prohibited transaction rules, right? So let's say you are deemed a fiduciary now under 4975E2, you're deemed a disqualified person. Let's say you're doing other transactions with any other entities that you have direct or indirect involvement. Now you potentially open yourself up to prohibited transactions. That's more of a minor risk. The bigger risk is under ERISA, where the investment manager or their team would be deemed to have that heightened duty of care to the customer, to the client, which again just adds a lot more risk than you would have otherwise. And that's why all major private equity, venture capital, real estate, hedge funds will do everything in their power, and they make sure they decide when they're going after and accepting investors and getting subscriptions agreements from investors that they stay under 25%, or they'll use the VEOC or the REOC exception to make sure they're not triggering the plan asset rules. For IRA investors, if you're investing in a private equity fund, venture capital fund, real estate fund, they're going to tell you this stuff. So don't think you have to be an expert on plan asset rules. The plan asset rules, if they get triggered and you're just a regular IRA or 401k investor, it's not going to change anything into your risk profile in that investment. This is more of a risk on the investment manager, less on you as the IRA or 401k investor. Of course, you need to do your diligence and you need to do your research and make sure you have the appetite for this type of investment from a risk reward standpoint. That, of course, is a given no matter what investment you end up making. But for the investment manager, if you're triggering plan asset rules and ERISA, then that duty of care, that diligence, that responsibility to the client gets heightened to the level of a fiduciary, and it is a much larger responsibility and risk from the investment side. So that's why they're the ones that are going to either allow you to go in because they're under the 25%, or they could end up stopping you and say, hey, we just got too many retirement accounts in this deal. We can't take your investment. Even though they may want your money, they may come to you and say, listen, you may just have to do a private investment. We can't take IRA money because we're very close to that 25% threshold. And I guess the venture capital exception or the real estate exception just may not apply, or they just may not want to even hang their hat on that exception. They'd just rather stay under 25%. So they didn't have to play into that exceptions and worry about asset valuations and the 50%. Most funds will just be like, no, less than 25%. That's it. It's a hard rule. And we're not even going to rely on these exceptions. It's not worth it. Because trust me, these investment managers do not want to be deemed fiduciaries. Okay. They like to have more flexibility, control, and they don't want ERISA, Department of Labor, really, barking down their throats in terms of looking at everything. And it basically restricts potentially them for doing certain deals, certain transactions, and earn certain fees that could be deemed in violation of their ERISA fiduciary duty if they trigger the plan asset rule. So that's today's podcast. I wanted to do this because I do get some questions on plan asset rules. To be honest, most clients I work with have no idea about plan asset rules. And that's okay because most attorneys and accountants I work with have no idea about plan asset rules. It's a very specialized set of rules that really only get triggered in the investment world. So if you are involved with investment managers, asset management, raising a fund, having a fund in any capacity, whether it's businesses you're buying or investments you're doing in the hedge fund, vis-a-vis the private equity venture capital world, every single fund manager team is aware of plan assets, but sometimes they're not sure of kind of how it applies to IRAs and 401k. So I do get these questions a lot. And sometimes I just get questions from investors saying, hey, I see this language about plan assets in the docs. Do I have to be worried about it? And the answer is generally no. It's more from the investment manager's protection. It's nothing to do with you as an IRA or 401k investor. If you trigger plan asset rules, it's going to be a bigger risk to them than you. Your biggest risk is that the investment doesn't materialize. Generally, you're not going to have to worry about prohibited transaction rules because you're doing a passive investment into a fund, assuming you're not a GP or just an LP, a limited partner with no management responsibilities. There's very little prohibited transaction risks. But from an investment management standpoint, an asset management standpoint, if they do trigger the plan asset rules because they're above 25% ownership, it's not an operating company, there is substantial fiduciary risks that could potentially cause them a lot of aggravation, a lot of additional risk, and potential liability. So that's something they absolutely make sure that they are aware of and understand how those rules work. So that's it. I hope you enjoyed today's podcast. A really important one. If you're watching on YouTube, thank you so much. Please subscribe to our really amazing YouTube channel if you haven't already. We drop 3 podcasts, including this one. So you can always watch it on YouTube if you don't want to listen to it. And we also drop 3 to 4 videos a week, including a YouTube live every week. So that's something that you should definitely subscribe to if you are interested in learning about self-directed retirement accounts, alternative assets, tax rules, strategies for sheltering gains and income from tax, and just want to be on the cutting edge of anything alternative assets, tax, and retirement accounts. There's no better place to be, I promise. I put all my effort into this, and I'm really, really excited about kind of where we are and how much great content we have. So thanks so much for listening. Appreciate the support, and I hope to see everyone again next week. Take care.